Ever seen traders shouting on a stock exchange floor, surrounded by flashing numbers and a whirlwind of energy? It might look chaotic, but beneath the surface, there's a method to the madness. At the heart of all that commotion is something surprisingly simple: price action. Price action is the story of how a stock's price moves over time, captured in every tick and every bar on a chart. It's the purest form of market data, stripped of all the noise and opinions. Think of it as the raw data of buying and selling, a visual record of human emotion, fear, greed, hope, and uncertainty, all playing out in real time. Every spike and dip on the chart is a reflection of traders reacting to news, rumors, and their own instincts. Price action traders believe that everything you need to know about a stock is already reflected in its price. They don't rely on complicated indicators or predictions. They trust the chart to tell the story. It's a bit like reading footprints in the sand. By studying the patterns left behind, you can get a sense of where the market's been and maybe even where it's headed next. The clues are right there if you know how to look. This approach is all about tactical trading, making quick, informed decisions based on the immediate story the chart tells, rather than relying on distant forecasts or gut feelings. It's about reacting to what's happening right now. In a world flooded with endless information, price action cuts through the noise. It gives traders a clear, visual language to spot opportunities, manage risk, and truly understand the market's collective psychology, one candlestick at a time. Now, let's talk about where price action matters most, the S&P 500, or SPX. This index is often at the center of financial news and market analysis, and for good reason. It's not just a number on a screen, it's a reflection of the collective performance of America's corporate giants, and, by extension, the broader economy.
The S&P 500 tracks 500 of the largest U.S. companies. Think Apple, Microsoft, Amazon, and many more. These are the businesses that shape industries, drive innovation, and influence the daily lives of millions. Because of this, the S&P 500 is widely considered the ultimate barometer for the American stock market, offering a snapshot of the nation's economic health at any given moment. When the SPX rises, it signals economic strength and growing investor confidence. A rally in the S&P 500 often means that businesses are thriving, jobs are being created, and consumers are spending. On the other hand, when it falls, it often means widespread concern. Investors may be worried about economic slowdowns, global events, or company earnings, and this anxiety is quickly reflected in the index's movement.
For tactical traders, the SPX is more than just a headline or a daily update. It's a map of market sentiment, showing where optimism or fear is taking hold. Every tick up or down can reveal shifts in the collective mood of investors.
Analyzing the SPX helps traders decide when to buy or sell, providing crucial context for individual trades. By studying its trends, traders can spot opportunities, avoid pitfalls, and make more informed decisions about their portfolios.
Patterns on the SPX chart can signal what's next for countless stocks, offering early warnings or green lights for action. Technical analysis of the index can reveal support and resistance levels, trend reversals, and momentum shifts. That's why the S&P 500 is often called the compass for navigating the market's waves. It helps investors and traders alike steer through uncertainty and volatility with greater confidence. By watching SPX price action, traders position themselves to ride the market's trends, not get caught off guard. In a world where markets can change in an instant, understanding the S&P 500 is essential for anyone looking to stay ahead. How do traders read charts and make sense of all those price movements? One of the most fundamental tools in their arsenal is the concept of support and resistance, key price levels where trends often pause, stall, or even reverse direction. These levels act as invisible barriers on a chart, shaping the way prices move and how traders react. Support is like a sturdy floor where buyers step in, creating a cushion that prevents prices from falling further. When the price approaches this level, it often attracts more buyers, leading to a bounce upward. On the flip side, resistance acts as a ceiling where sellers push back, making it difficult for prices to climb higher. When the price nears resistance, selling pressure increases, often causing the price to retreat.
These crucial levels aren't just random lines. They form at previous peaks, troughs, or psychological round numbers that traders pay close attention to. For example, a stock might repeatedly bounce off a previous low or struggle to break above a round number like 7,000. As of January 20th, 2026, the SPX hovers near 6,940.01, with support at 6,128.20 and 6,495.82, and resistance at 7,196.24. These numbers aren't just statistics, they're reference points for thousands of traders worldwide.
Traders use these levels to plan their entries, exits, and stop losses, buying near support, selling near resistance, and protecting themselves from unexpected moves. This approach helps them make more informed decisions and avoid emotional trading.
These battlegrounds define the playing field, helping traders manage risk, set profit targets, and develop strategies that adapt to changing market conditions. Recognizing these zones can be the difference between a winning and losing trade.
Understanding where these invisible barriers lie gives traders a tactical edge, allowing them to anticipate potential turning points in the market. Mastering support and resistance is essential for tactical trading, whether you're a day trader or a long-term investor. It's all about knowing where the market is likely to turn, so you can act with confidence and precision. Sometimes the market moves sideways, neither up nor down. This is called neutral sentiment.
The SPX is currently stuck between support at 6,928.20 and resistance at 7,196.24, creating indecision. Buyers hesitate to push higher. Sellers hold back from dumping shares. The result? Choppy, sideways action.
For tactical traders, a neutral market means patience. Some buy at support and sell at resistance, profiting from small swings.
Others wait for a breakout, when price smashes through support or resistance, signaling a new trend.
Neutral sentiment warns traders to manage risk and avoid getting caught in indecisive swings. It's a signal to be cautious and wait for a clearer direction. The market's way of saying, "I'm thinking, don't rush me."
Every trade is a calculation of risk versus reward.
Smart traders ask, how much can I make if I'm right? How much could I lose if I'm wrong? That's the risk-reward ratio.
Right now, the SPX offers a 13.4 to 1 risk-reward setup, risking a little for the chance at a much bigger gain.
For every pound risk, you could make over 13 in profit, targeting a 3.9% gain with just 0.3% risk.
Even if most trades lose, a few big winners can keep you profitable.
This is the secret to long-term trading success, stacking the odds in your favor. By seeking high reward for low risk, traders turn the market into a strategic business, not a gamble.
Like zooming in and out on a map, traders analyze price action on different timeframes for a complete picture.
The SPX's long-term trend is up, with strong support at 6,928.20 and resistance at 7,196.24.
But in the short term, signals are neutral. Think of it as a traffic jam on the way north.
The near-term range is tighter, support at 6,912.39, resistance at 6,967.23.
Smart traders blend these views. Long-term bullish, but short-term cautious.
Wait for short-term signals to align with the long-term trend before jumping in. This approach helps avoid false starts and improves timing. It's about patience and precision, not just direction.
Today, AI is a trader's secret weapon, processing data, spotting patterns, and generating actionable strategies.
AI suggests three main SPX strategies. Buy at major support, buy on a breakout above resistance, or short at key resistance.
The first is a classic buy the dip at 6,028.20, targeting 7,196.24, with a stop loss just below support. The second waits for a breakout above 6,967.23, aiming for 7,003.98 with a tight stop. The third is a short at 7,003.98, targeting 6,653.78, with a stop at 7,024.99.
These AI strategies are precise, unemotional, and adapt to changing market conditions. They give traders a clear playbook for any scenario. It's trading with machine-like discipline.
AI-driven strategies are now accessible to everyone, not just big hedge funds.
Modern trading platforms act as your co-pilot, delivering real-time alerts when key levels are hit.
You can track AI signal performance, customize risk, and get notified instantly. No need to watch charts all day.
These tools put you in control, with AI doing the heavy lifting.
It's a game changer, empowering ordinary people to trade smarter and more strategically.
With data-driven insights and discipline, you can navigate markets with confidence. We've explored tactical trading, from price action basics to AI-powered strategies. Understanding price action is a valuable skill for any investor. It's the language of the market. It strips away noise, revealing the story of supply and demand. Learning to spot support, resistance, and risk-reward gives you a framework for smarter decisions. Even long-term investors benefit, buying at support, avoiding panic, and improving returns. Price action knowledge puts you in control of your financial journey. By embracing these tools and strategies, you're equipped to navigate markets with clarity and confidence.